Thank you everyone for coming. This is our third installation of really what project founders and people who are working and building in Web3 need to know, really with a focus on finance and accounting, but I think there's a larger, there's a lot of things that fall under that definition. And tax is probably one of the most important pieces of that. I think I know most people in the room, but my name is Sam Leichman. I lead the blockchain practice at Propeller Industries. Really excited to be introducing our guest today. I knew Rob as Rob from the ferry for the first 2 years of our acquaintance, not having any idea what he did, who he worked for, or any backstory. And it actually took a 4-year-old's birthday party for us to actually get better acquainted. My niece, his daughters. But anyway, long story short, I took the ferry with Rob for quite a while, pre-COVID days, and got to know him over coffee, which is probably the best way to get to know somebody. But coming into COVID, realized that not only is he who he is, but we also were lucky enough to share more than a couple of clients and had a chance to work together professionally. But I think the work we do is helping our clients get their finance house in order. And really the first order of importance for all of our projects and our clients is, well, keeping them out of jail and making sure that their tax house is aligned. And again, is it 13 years ago that you founded the practice at
Almost
Deloitte?
13 years, yeah.
Anyway, let me stop talking and hand the floor
Thank you,
over
Sam.
to Rob.
Thank you. It's neat to have fairy friends and neighbors in this space, which is pretty cool. I am going to use it if that's okay, because I scream at people for a living, and so my voice gets tired. So I can dial it up or dial it down. But thank you guys for coming. As Sam said, I've been doing this a long time. So Deloitte's a really big organization. We're 400,000 people. So you can imagine when I asked in a long time ago, it's like, hey, there's this client I want to serve, and they read the paper, and it was all about Mt. Gox and Silk Road. They're like, that's a really bad idea. And I'm like, no, this could be good. We want to be on the front of this. That's a bad idea. And so after a while, we got into this, but we were very cloaked for a long time. But in serving this space, what we learned early was the uniqueness of the ecosystem throughout its different components. So when you think about new infrastructure, new types of investments, new types of assets, it was very clear to us about the impact that blockchain digital assets was going to have across literally every industry segment in the world. And that was what was the initial hook, which holds true today. So I was the first one. We are 2,000 strong now of people in Deloitte that work in this space across tax, across audit, advisory, and we do build stuff. We do have a consulting practice as well. So since I'm part of tax, and I think it's relevant to some people today, what I thought I would do is share some stories and different components about what we've experienced over the last 13 years. And that's touched about 1,000 companies, most of which are early stage growth companies. So even before they start the labs company, hey, what are we thinking about here? Do we want to start here? Do we want to start abroad? What does that look like? And we collaborate with counsel and other advisors in the space. That's been great. I am joined here with one of my colleagues, Han, who's exclusively in this space as well. So a couple of friends, and we can please be interactive, ask questions. I'm really tough to offend. You will learn this because I serve in this space. Yes, sir.
Real quick, what were the names that you were calling the business units and how they progressed in time? Crypto, Web3, like what sort of digital assets, or what's the next progression of the naming?
Yeah.
Is there a difference for the US side or global?
Yeah, we serve it all. Yeah, for sure, and without boundaries. So big global firm, and we do touch it all. Probably more expertise here. I will use crypto and digital assets interchangeably, although there's some people in the risk function that say, please use digital assets. And I'm like, yeah, but crypto's common. And so I think it's like, I don't really care. I think crypto is a little easier to digest, and we paint a big picture of it. But there's actually, we can talk about what we call these different things and why it matters, actually. So what I picked was just some topics, and if there's something you don't see and you want to just ask a question, that's fine. But I thought we'd talk about, early stage companies. The concept of issuing warrants along with equity is a really tricky topic that I want to make sure everybody understands, and at least what we have seen to be some pitfalls. And for a perspective, it applies to all these things. Early stage companies, what are you doing? Being careful about spend, keep it light touch. We can figure it out later. Some of these topics, there's no undo button, particularly when you're worth a couple of $1 billion. And then the anxiety really starts. Because in things like getting those warrants set up or issuing token-based compensation, and then you have to go back to the founder and say, gosh, I wish you had given this a little more care, because that's now going to cost you tax-affected, $800 million. So those are some pain points. So we'll go through comp. We'll talk about decentralized teams, because nobody cares where you sit anymore, and what does that dynamic do when you have people around the world, humans coding and contributing things. The use of a foundation, wallet, treasury management, and a significant uptick in IRS exam activity, and importantly, collaboration between different federal agencies and also at the state level. So just some topics. We can talk about anything you guys want, but this is where I thought I would start. Is this fair? Okay. So to your point around digital assets, what's the thing? We actually have t-shirts. I should have worn that one today, is what's the thing? And it's a silly question, but really important, because we have digital assets of all these different categories. We've got, those representing, store of value. They're on a layer 1. Now we've got layer 2s. What does this stuff do? We have NFTs that represent a bundle of rights. What do those things represent? And with the tax lens, different than the accounting lens, different than the security law lens, it all matters. And so we really have to think about what we've created, and what we've created on the early end may not be what it actually matures to. So we got to watch that. Where does that come up a lot? Big companies now, large scale enterprise that have loyalty reward points. So wouldn't it be cool if we made those, what if we tokenized those things? They could trade them off platform, we gave them other rights. It's you just created a tax problem. That's what you did. So we have to watch that continuum of people adopt all the cool stuff in this space. And so these are just sort of some strata we think about, the decentralized old school crypto, I think we get that. Stable coins are not all created equal. And I'll just throw this out there. Even when you say, yeah, it's just like $1, why do we care? Fiat currency is only issued by central banks. Even though it feels like $1, it tracks really close to $1, but for those 40 basis point differences in a 24-hour period, it's not money. When you put the tax lens on it, even the cleanest, like USDC, right, super white, super clean, that could be a debt instrument. It could be a security with the tax lens. I'm not talking about Mr. Gensler over here. I'm talking about tax. And that means you've changed what the transaction represents if you're now using stablecoins in constructing financial products. So that's why we really have to go deep into what do these things represent? What are the rights and obligations that a holder has if they have digital assets? Obviously, tokens have taken different forms. We have, tokenized diamonds, tokenized palladium, I think is a thing, gold, which all makes sense. But then you have to say, well, is it a digital representation of that thing, that specific thing? Or is it a right to redeem those things somewhere in the world? That's two different things. A right to redeem, maybe a derivative, is very different than a digital representation of that troy ounce of gold sitting in that vault in Zug. Two different things with the tax lens. And so those are the Massey nuances we get into here. Obviously, NFTs have gone just nuts, and beyond the silly apes, we're seeing a lot of our large-scale enterprise players understand, what do NFTs represent, and importantly, the different rights and obligations that are owed to a holder. So if you said, oh, well, we have this super high-end bottle of whiskey. This is a true story. I won't give away the name, but super high-end bottle of whiskey. And, with this NFT, you can redeem that whiskey. And by the way, if you engage now, we'll send you on this exclusive trip to Scotland. And then, so now you've got this super cool JPEG, you've got whiskey, and you've got a trip to Scotland. Those are three different things, all taxed differently from a VAT perspective. Ouch. Sourced differently. What do we do with stuff like that? So we've created these really cool business models, but everybody's head explodes. So then obviously digital securities, right? We're talking about tokenized equity. We're talking about tokenized products, financial products, which honestly a lot of regulators really like because you bring transparency to the design. Back in the day, not long ago, people designed these really sophisticated financial products, and it was buried in all this legalese. And then every once in a while, a regulator would study what you actually did, and they would check your actions against what you said you did in legalese. And if they matched, great. If you're out of bounds, you're in really big trouble. Regulators now are like, if you coded this stuff, we can see on a real-time basis whether what we said you would do, still in legalese, matches the code. Pretty interesting. So behind the scenes, Mr. Gensler's team, maybe they like this stuff, tokenized instruments, because they know what people are doing. Interesting. So more and more of this, I think, is to come. We're all studying CBDCs. Y'all should know that we have the digital one, the digital ruble. These are live CBDCs in the world. The US digital dollar may be the last of the G20 to adopt. That's not a political statement. It just means that we have more debate on the Hill on things like privacy than other countries in the world do. But this is a really big thing around the world, so we should all be watching this. Okay, so that's how I think about tokens. Is that helpful to your earlier question?
Where's the yield, forward yield vary?
Yeah, I mean, probably somewhere in the token category, right? What have we built, right? They're usually attached to a protocol. They're native to something, and then we've designed financial products around them. Yeah. These are the buckets I use anyway, and it helps keep my head straight when we're having these conversations. Yes, sir.
We're winding back from the NFTs and regarding the IRS consideration of them
Yeah.
treated as collectibles.
Yeah.
And all the implications.
Yeah.
Comment period.
Yeah.
And the implications that they have.
Yeah.
You can access certain sort of like opportunity zones.
Yeah.
Not, as I understand it, invest in
Yeah.
collectibles, for instance, and now you all of a sudden have an asset class
Yeah.
that's now prohibited to touch. So do you guys comment?
Sure.
During that comment period?
Absolutely.
Speak to it?
Absolutely. So we as a firm, we don't generally comment directly. What we do is we are involved in different industry groups. So the Digital Chamber of Commerce and GBBC being two of them, which we collaborate with other firms, law firms and accounting firms and other advisors to say, what do we think is the right thing to say? And there was for those of you who didn't see it, there was a notice put out, it was earlier this year, around NFTs representing a collectibles. The real impact was around retirement accounts. Like, are people really doing this? I guess a few, but it's more than that exact impact. What it said to us was that the service, give them credit, they were doing a good job. They were looking beyond the JPEG. What is this thing? They've heard this talk. What's the thing? What are the rights and obligations of a holder of that NFT? And so we have to look through. They started using this vernacular like you have to look through it. They're right. And so we can't stop at just the code. We have to say, what are the rights and obligations that come to the holder? They didn't exactly use that language, but that's where this is going, and that's where the comments go. And then, what a lot of us commented on was, hey, here's all the rest of the stuff that you should think about beyond retirement accounts with NFTs, because it is elevating commercial activities. That's what's happening. Right? We're watching people evolve, much like we evolved in the late 90s, right? When we started seeing e-commerce start to emerge here in San Francisco, in fact. We're starting to see that same thing happen. The get it factor is catching up with NFTs. So, fun. Super quick call out, when we serve in this space, I know it's hard to have a bunch of people around the Zoom party when you're studying these things, but really bring your friends and make sure that you not only have the tax lens on stuff, let your tax people talk to your counsel. Let them talk to your bean counters, right? Let them talk to your back office, whomever it is, and work together to protect you. The right advisors will work collectively to protect you for your best interests, and we can see around the corner. So broaden that team a little bit.
What advice would you give to an early stage project that maybe even pre-seed?
Yeah.
This is a pretty expensive stack that we're looking at here, and maybe even through the lens of just how do they begin to think about this, begin to think about interacting. Deloitte is a very big firm that I think serves off a lot of projects. But what advice would you give to the pre-seed or seed founder that is just getting the business?
And not all advisors bill by the hour, right? We in fact don't, and so we take on a lot of early stage clients. And maybe to your example, having somebody think on your behalf without making a big project, conversations are pretty easy. It's the memos that are really expensive. And so when you're iterating through and you're going to change your story 72 times in the next 4 months before you launch something, then just have an evolving conversation, right? Of course, there has to be an engagement. They're going to be paid for something, some level of advice, but it doesn't have to be a big thing. But importantly, tied in with counsel, who's also going to give you a little bit of latitude to make sure we're synced up, along with a valuation expert, because there's going to be valuations somewhere along the line. Thank you, Neil. Right? And somebody in the back office, right, Sam? Like, we need to make sure we're all coordinated on what these things represent. It doesn't have to be a heavy touch, but to bring people along the journey of iteration is important. And then you revisit this and build out your team later. That was all the general stuff I wanted to cover, just to level set. So can we talk about warrants? Okay, has this come up? You guys think about token-based warrants, tokenized warrants? Big deal. Okay, good. So I'm hitting at least a couple of chords in the room. So this is an old as the hills topic. People issue warrants. So people issue equity, right, or safes, and then a warrant kicker to incentivize people, right? But what is that transaction? When you issue a warrant for equity and people exercise that warrant, you issue equity. So it's equity in the front end, equity later. Do we really care? When corporations issue equity, it's a non-taxable transaction. Nobody cares. Nobody cares about timing. It is what it is. The holder may care about timing because you start your holding period, but the corporation doesn't generally care. It's non-taxable event. Did I do something wrong, George? I'm okay. All right. So what's different about a token warrant? With a warrant, we're delivering property of some kind. Going back to that what's the thing question. It's property. So now it matters. Because if you issue one sheet of paper, I depicted two sheets of paper here. There's the equity, and then there's the token warrant. So if you're really good hygiene in the legal documents, the actions taken forth with the two different pieces of property and the technology, so there's no confusion. Two different papers, one for equity, one for the token warrant. There's terms that say things like, if you want to keep your equity, but you want to sell your warrant to somebody else, you can do that. Separately transferable. Separate paper, separate funds to ink both. So we clearly have two separate instruments. Then when the labs company in this example issues the equity, they take in funds of some kind, could be crypto, could be fiat. It's fine, non-taxable transaction. When they issue the warrant, now they have what? Early stage tokens, zero basis, high value. It's got some value. You can't say zero. You can say a little, but you can't say zero. So then they issue those tokens. What happens then is it's still a non-taxable event to the labs company in this example. Why? Because they've taken this instrument, they've taken in funds, they've taken $1,000 for the warrant, right? Maybe it's $1,000 to buy it and another $1,000 to exercise it. Right? So the first 1,000 they took in, it's not income yet. The second 1,000 they take in when the holder chooses to exercise it, and then they deliver the tokens. They have $2,000 of income, period. Okay? The holder, when they receive those tokens, they may be worth $2 million. The holder takes on a basis of 2,000. Okay? So if Neil's the recipient over here, right, you're going to be the holder here for a minute, you're exercising the warrant, you now have 1 million tokens worth $2 million, very low basis, $2,000, good move. Everything is clean. That's what we would expect. That's the words being used, that's the expectation, but really good hygiene. Now let's go the other way. Now you have one piece of paper, one fiat exchange. They send you $1,000. Maybe I only talked about the exchange on the warrant side, but they gave you all the money for both the safe and the warrant in one wire. It's one piece of paper, and they're not separately transferable, kind of like stapled stock. In legalese, and maybe even technologically, they've bound it such that you can't move one without the other. What have we done? We've recast the situation. You can call it what you want. The form of the transaction's a warrant and a safe, but in substance, you have one document. So why do we care? We've recast it such that when the labs company takes those tokens worth $2 million in my example and gives them to Neil, that is a distribution of property to a shareholder. And there's this silly little code section, 311B, if you have insomnia, you can read it. And it talks about distributions of appreciated property out of a corporation trigger gain at the corporate level. So now the corporation's just triggered $2 million of income tax, of gain, taxable at whatever rate we're at. Ouch. What makes it worse? The corporation now has earnings and profits, meaning that the character of that distribution to a shareholder is a dividend, meaning it's not just taxable at the corporate level, it's taxable at the holder. They're going to get a 1099 DIV with $2 million on it. Ouch. Ordinary income. Ouch. So now, poor Neil is harmed. So it's okay, I'm using it as an example. So, so you're harmed because your equity value is now short by the tax impact of that bonehead move on the front end, right? And he's got to pay tax on the tokens he just received. Not what anybody expected. 98 times out of 100, the token warrants we look at are in the bad example because nobody took the time on the front end. The attorneys and their advisors didn't catch this, and I can't fix it later. Yes, sir. Yeah, you need to paper it differently. Yeah, separately negotiated stuff. So, and we can go through volumes of different data points to consider. I highlighted a few. But yeah, anything that's kind of attached on that early end, then you got a high likelihood that it's going to be recast as a distribution and everybody gets harmed. So, but this happens really early, doesn't it? You want to incentivize some early rounds. It's maybe just beyond friends and family, but we got to take care on this topic. I don't know. And we talked to a lot of counsel about this, and it still slides in there because people are like trying to do it on the cheap. They're trying to do it fast. They download something on Google and issue these warrants, and it's really a sad state. And everybody gets harmed, and then you're stuck because as a CPA, which I didn't start by that, but I do sign tax returns on occasion, and I have to now sign off if I'm signing that labs company return. Like, how is this treated? And if I don't feel good about the nature of this transaction, can I even sign the tax return? Ouch. David wouldn't sign it. He wouldn't. It's like, what do we do with this? But it's a really uncomfortable situation. Okay, I should have worn the other T-shirt which says "We scare because we care." Sorry.
In those 98% of problem cases, is there a theme of, is it an attorney who just isn't familiar with this, who is my dad's cousin from a previous marriage and they're doing it really cheap, or what's?
It could be. I mean, by the way, this is not an expensive thing on the front end. It's really just a discussion to make sure that it's thoughtfully papered and the actions match. It's people that just aren't familiar with it. This is not to bash law firms, right? That was not the intention of my story. It's just a level of care. And people don't understand, what it is that they're designing. And what we fall into the trap is designing business models and transactions that match the economics of something we've understood for 100 years. But when you pull out fiat, when you pull out security and you insert the word property of some kind, you have to reevaluate all the basics. Fun stuff. Yeah, so when if you have a warrant flavor to what you're delivering, and the warrant attached to tokens, obviously, because that's the only time this matters, think about what you're issuing and make sure there's a high level of care to two separate instruments. Funds coming in for the warrant, separate than funds coming in for the safe. Separately negotiated, ideally separate recipients, right? You have a different cap table than the warrant holders, or at least the ratios are different. I like that one a lot. Separately transferable is a really big deal. If they're stapled together and they say you can only get rid of the warrant if the equity goes with it, bad move. There's a laundry list of these, but like just high level of two separate documents for sure. Negotiated at different times, really helpful. So anything you can to just respect these are not the same thing.
It's also surprising that on the other side, that the VC isn't like, hey, we want it set up like this because they're kind of downstream.
It's a great comment. We work with a number of VC firms, crypto native and otherwise. And what happens is if you get brought in too late, you can't maybe change the deal, or if they're not the lead, or if you have an advisor and that says, oh, don't worry about that. It's fine. I don't know. I've been in front of the IRS. This is a tough topic and you can't fix it. And everybody gets harmed. Yeah.
Maybe we want it set up this way because so and so set up this way as well. Earlier before making a list, you had on one of your slides on foundations.
Yeah, we'll get to foundations. Yeah.
Okay.
Yeah, for sure. Hot topic. Yeah. Well, so and so did it that way. Why can't I do it that way? Well, so and so may not be really happy when it gets a little love letter from a 3-lettered agency. So, okay. Yes, sir.
Is this assuming there's foundation involved, or is it, this is irregardless?
Great question. This is a US concept. I should have put a US flag here. The concept of appreciated property leaving corporate solution causing a tax event is a common theme around the world, not applied consistently, but this is a US rule. So if you have a foundation, and maybe remind me when we get to that, or I can go there now if you want. Should we talk about foundations and just pivot there? There's no lineage in any of the stuff I'm talking about. So we can, okay. So, and I didn't put a flag on the foundation. We can talk about US UNAs. Do we do UNAs in the room, or are we just doing non-US foundations? Okay, we should talk about both. So Switzerland, Caymans, right? Those are my two favorites. It's surprising. We have more and more, right? Do you know why? Well, this is the topic. There's anywhere in the US, because if you have US, if let's go your Cayman route. Let's say imagine a Cayman flag. I should have put this on the slide. Imagine a Cayman flag attached to the foundation. Great, we can do that, but only if it has substance. If it's US people that are influencing the actions, making management decisions, have the rights and obligations, even though there's no shares issued, but maybe they're kind of owed something in the background, you're going to have a US permanent establishment, which is painful. And the reason that you see more and more US in the considerations for foundations is because those who set up Cayman foundations, a lot of them are like, this just isn't workable. I don't have people that work there full time. I don't want to go there with that much frequency. It's not doable. Now there are, like in our background, we've seen a lot of people that have tested out. It's like, hey, we're staying. And the immigration laws in Cayman are very friendly, and so they've built teams and that works. But I'd say that's a very low percentage, which is why US, Switzerland, Cayman, and maybe Singapore are online most often. I don't want to hear Panama. Panama is not allowed in this conversation, by the way, so, for a bunch of reasons. But those are probably the top four. So if you go back to my other example and you said appreciated property and you had a believable Cayman foundation that owned the IP, we got the tokens there in a legitimate way, and they delivered on the warrant, you would at least not have the anxiety in the Cayman Foundation because Cayman is a zero tax jurisdiction. You may still have the anxiety on the recipient level, right? Because you still have to put the U.S. lens on it if it's a U.S. VC firm, but probably less. So what do we think about with foundations? We already talked about jurisdiction. I put a little red line here for disaffiliation. There's no code section that defines disaffiliation. It is a concept that has been debated in the courts much longer than I've been walking around. And what it stands for is that if you have the same direction, the same set of humans, you've got too much reliance between the two parties. Maybe all the funds consistently come from one place. It's not really arm's length. We can go through a laundry list. Then you may not be disaffiliated. The labs company, in my example, may not be disaffiliated from the foundation. That creates a problem. Your counsel may have a different problem than I have, but you want to make sure that you have this disaffiliation, because when you're going to have transfers, more often than not, you have a U.S. labs company. That's usually where things start, somewhere in the Presidio maybe, and you're developing IP, and you're like, this is just not a good place to launch. Our attorneys are like, this is not going to happen. Too frothy, too spicy right now. And you decide to send things to the foundation. If you don't have effective disaffiliation between the two, you've now transferred outbound intellectual property, which is taxable in the US. It's expensive. The IRS exam on outbound transfers of intellectual property, the debates are as old as the hills. But it really gets spicy when you transfer protocols and crypto and IP attached to decentralized protocols out of the US for a bunch of reasons. And what's fascinating, what we found under exam, is that these agents are getting really sophisticated. They found out that you can actually go into GitHub and you can see the evolution of the code, and it's got a little date, and it's got comments, and you can see who committed that code and where they sat and when. So gone are the days where you used to get IDRs, informational data requests from agents to ask questions. No, they just go to GitHub, check out what you did. They build their own narrative. about when you transfer the IP and how what you said on stage compared to what you coded, compared to who did it and when. Unbelievable. Yes, sir. Yeah, it applies. I know this. It's a weird concept, right? It's open source and it's nobody's. It doesn't care. But if you created it, even if you still have more control than other people, it's still IP as the IRS would define it, probably. I know that's hard to get your head around because you don't control all of it, right? It's not like we've built an app and put it on iOS. I completely appreciate that, and we've had this debate. It's probably not a winning argument to say it's open source with the tax rules. It's hard. Yes, sir.
Zooming out a little bit in practice, are agents, does there have to be an audit for agents to start with that, or do they just do what they're curious
Yeah.
about?
There's maybe less accountability right now in certain agencies than there has been in the past. Yeah. They're looking around. They're studying. I don't know. I can't answer why or whether or not that's appropriate. I just know that it may happen before you get the IDR or the notice. Oh my gosh, everybody. Yes, sir.
So generally, you have the setup where protocol is open source, part of the Cayman. Then you have labs, which is running the front end.
Yep.
Are we talking about the IP of the front end? Are we talking about the IP of the protocol?
Either. So it just depends. People do different things. Like how do you want to design it? So in a more complete example, we would show flows of token transactions, human contributions, like what's actually happening here. And once it's mature in a mature state, what is happening, front end, back end, control, tokens, treasury, whatever it is. And then we would decide what's going across and whose is it and what is that transaction really. It doesn't have to just be a transfer. It could be a license. You can design it a bunch of different ways, but it tends to be the common thing where you just like lift and shift a bunch of stuff over. And then there's a lot of other considerations, which, I mean, we can do that too. It may be a lot of different dependencies in the example, but that's exactly what we do. We chart out the flows, see what makes sense. Mackenzie, you had a question. Yeah, it's a really good question. So we'll geek out for 1 second here. And in today's rules, when you have R&D expenditures, research development, we're building protocols, that's what we do. Those are like, wind back the clock 2 years, those were all deductible normal course. So you would write it off and you would have zero basis and stuff. Today you have to capitalize and amortize it over either 5 or 15 years, depending upon where it's developed. It's a huge pain. So then you would have some basis in what you've developed. And then you send it across, and we find it to be really important that you get a valuation in different components. And so that valuation would delineate, core code. It could be social handles. It's definitely tokens if they're going across, and if they're early stage pre-launch tokens, then there's some really interesting ways to do that. There's a particular expert right here who knows more about that than anybody. And so having the valuation is a big deal. So because the labs company still has to put it on a tax return, they got to report this thing. And so sometimes it could be a business transaction. So in a perfect world, and Han and I spend a lot of time on this topic, in a perfect world, if you take a bunch of IP that was in labs, Neil values it at $5 million. We're like, oh, okay, it's fine. So when I transfer that across, I pick up gain. Sorry, it's a taxable transaction, right? So I've now picked up $5 million of income. The question is, do a $5 million deduction because it was a business transaction. That's the cleanest. Whatever you've capped and amortized, though, in your basis may have a period of them, like a hangover period and the base recovery on that piece, but at the very least, you can get a deduction for the component between basis and fair value. Now, that's if you transfer it across. You can do it in different ways, but that's maybe one of the more common ones. Did you want to clarify something I said?
With the capitalization of R&D before, it's always basis. No matter how you do the transfer, it will always be current basis, so you can offset the gain with it as opposed to having to amortize.
I think we're all living with this. I had thought we didn't have a workaround that I had to keep whatever basis I had left to amortize. I had to maintain that. So like, let's say I capitalized, 100 grand, and so far I've amortized 10, so I've got 90 left, and the thing is worth my $5 million example. Then I would have, I can't even do math in my head. Like just, I'd have the 80 basically I have 80 left of basis, which I keep amortizing. And then I've got my 4.1 or whatever it is, 4.2 of gain. And then I can deduct, right? I don't think I can recover that basis. I think I'm stuck with it. I think I have to continue amortizing.
See it in a sale, asset sale.
Yeah.
Take the basis against it.
I think when you read 174, you're stuck with it. I mean, I've not had this debate yet, but a couple of
That's
casual.
a really open question. Any kind of asset sale.
Yeah, it's bad law. It's terrible. But I didn't, this is Congress, right? We talked to them about it.
There's no regs.
We don't have regs yet, do we? Yeah, they're buried with other stuff. Yes, sir, I'll come back. Mm-hmm.
Now, because they're in different dates, ideally, it does take place as wholesale. Total warrants are now foundations. How does that leave it?
Great question. So if I heard you right, you've originated some stuff in labs, you transferred the foundation, and the token warrant is one of those components. Is that right?
Yeah, I had token warrants after.
Yep. Yeah, the cleanest thing we see is when the labs company takes it to a state, if your council agrees with this, and you actually mint in the US, and then you transfer to foundation the protocol, rights to protocol, GitHub repo, all the rights to control that thing before it's out, your social handles, tokens that are going over, and the warrants, and then let the foundation deliver on those. So all those things would be valued differently and be a rather sophisticated transaction. But the reason you like that is because it's one outbound, which is a business transaction to launch. What we hesitate on is when you send it across foundation mints and then they send back the tokens. Then the worry is that if those tokens are worth, $1 billion, whatever, that's income to labs when they receive them. There's ways that people try and architect around that, but it's a lot of anxiety in the system for me anyway. The bookkeeping is less relevant. It's just about the values and what you would record for tax. So you may not have anything recorded for book purposes. It may just be like a memo entry. Yeah, accounting doesn't drive tax. Isn't that funny? It does in Europe, by the way. If you did this in Europe, accounting controls a lot of that, but not here in the US. Yep. Yeah, so the tokens would have zero basis, right? It took me 2.5 minutes to code tokens, probably, shorter for you guys. And then Neil's going to value them at some number at the time that they go across. Yeah, my basis is 0. And so that's why, from a token perspective, it all equates to gain. Yeah. Tricky. We can put all kinds of arrows on the slide if you want, but yeah, that's kind of the gist of it.
Cleaner when foundations may be located in jurisdictions that may have tax treaties.
It's a great question.
Function, and then obviously you have to go.
Yeah.
Puerto Rico that can't sign a treaty.
It's great.
Like Cayman that may not sign a treaty, and I know we should talk about Panama, but I think it is not a treaty. And then I guess where my question was going, speaking of Europe, is how is this going to change in terms of renegotiation or amendment of any treaties coming online?
Wow, it's great questions. Okay, so first off, true statement, Cayman Islands has no tax treaty with the US, which means it's a hairline trigger. If you have any activity of the Cayman Islands that takes place on US soil, you have a lot of risk that the US is going to want to tax whatever's happening to Cayman. So that's a big deal. Go the other end of the spectrum. A lot of countries out there throughout Europe have good tax treaties with the US, which means we have a little more protection on what we're doing here. If you do have a foundation in Europe, VAT is a really big thing on tokens. And so we're not used to that, right? A lot of financial products are exempt, not tokens. And the rules vary by jurisdiction, they vary by token, but the way I think about VAT is that the more that it's money-like, you have a better chance that it's exempt. The less that it's money-like, the less chance it's exempt activity. And so then you have irrecoverable VAT somewhere. Could be on the end sale, could be in the foundation, depends on where you go. But VAT is a big thing. MiCA is a big deal. I don't know that it really influences a lot of what we're talking about here. It probably happens later in how the operating foundation or if they have ongoing business operations, are going to be compliant with MiCA, I think. Does that catch all your components? Uh-huh.
For instance, the redemption of a utility token.
Yeah.
Where does that occur?
Let's- Yeah. So I'm a VAT novice, but let me just chart through some of the pitfalls here. So leg one, labs to foundation. If labs is US and foundation is Switzerland, that first transaction may have VAT consequence. So whatever the value is times 13%, I think, is the lowest rate you're going to get in Switzerland, I think. Keep me honest there. So again, going back to the valuation, and it may not attach consistently between the components of IP. That's leg one. Okay. Then, and by the way, depending upon the type of foundation you set up in Switzerland, it may also have an income tax consequence to the Swiss entity. So you got to be careful how that's set up. Then when you come out of Switzerland and you're giving grants, you're engaging in a transaction, then that next leg of the transaction may also have a VAT consequence. Now, if we determine that the foundation is a non-exempt entity, then they may have the ability to recover that VAT. Usually there's a mix of exempt and non-exempt activities, which you also want to build into your rulings, because in Switzerland, it's a very German influence thing, so you will get a ruling for everything you do in Switzerland, right? And so you probably want to build VAT into one of the rulings you secure in that one. So VAT is a really big consideration when we go to Europe. There's usually some leakage, but at least you've got a regulatory environment that we think is becoming stable.
So I guess on the transfer of the IP, is it for an operator, is it in your benefit to have a higher value of the IP or lower? And then kind of figure out like what motivations you have.
Yeah, I mean, it's got to be believable. It's got to be reported. The recipient, to the extent that they care about basis, right? If their taxable jurisdiction goes across, then they would want a lower value, obviously. But if it attaches basis, then they would get to recover that presumably over some period of time. I don't know. We've seen a huge range of these things. Lower numbers usually has less anxiety. If you put a really big number in a tax return, that gets more attention. But it's got to be realistic. It's got to be supportable. It's got to be contemporaneous. Please don't do evaluation later. Well, if you haven't got one, do it later, but do it on the front end. Do it before you execute. Contemporaneous documentation. Is this okay? I feel like I'm scolding everybody in the room. Everybody trying to do the right thing. Okay. Is this helpful for foundations? Sort of. Okay. I mean, these take all kinds of different flavors. Come back to it. Do you want to talk about token-based comp a little bit? We see a lot of problems with this. Okay, so what does everybody want? Tokens, give them to me early, give them to me now. And so it's going to be a billionaire. And so you have to be careful because the compensation rules are really tough in the US. And we've all grown up with this concept of like, oh, it's great. It's like, just make it happen and give me an A3B election, and then I get this huge tax benefit, and I'll maybe pay tax later. But the problem with this is, again, in with the design. And so thematically, it's similar with the token-based warrants. We need to talk about substance. We need to talk about the form. So the best practice. Okay. Labs mints tokens. They exist. That's point one. They're real. As much as a token can be real, they're real. Okay. Then they transfer them. You see an arrow depicting a transfer of my yellow token to this human. Lock it up in a wallet. Something. It's a multi-sig, it's a something. But a transfer is really important. The transfer of property to a different place. Okay? But lockup's not whatever you want. Substantial risk of forfeiture. If it's just, if they're going to get it, right, no matter what, just the passage of time, in 3 years, then that's a problem. So there's got to be a risk that if this young lady does something wrong, she leaves the company, she does something nefarious, she will lose the token. That risk of forfeiture is a big deal, okay? Because you're going to put a vesting thing on there or a lockup or whatever it is, pick a 3-year period. So if all that works out and she makes an 83B election based on a real valuation that does not take into consideration a lapse restriction, then that value, which could be very, very low, is compensatory to her when she receives it. Compensatory translates to the $10 that it's worth when you do the math goes on a W-2. There's real withholding tax, and there's only a couple of states in the union that take withholding tax in something other than fiat. So now we've got to do all that math and make sure that they get their fiat withholding tax. She picks it up as income on her 1040, and the world is good. Then when she stays, she does all the work. The vesting restrictions come off. Then she has $10 basis in those tokens. The holding period is what it is. She'll sell them for capital gain at some point in the future, and everybody's happy. So that's a good example. Let's go a bad example. Let's say that, okay, they mint the tokens, but they don't necessarily transfer them. They sort of just allocate them. They don't even set up a separate wallet. It's like, hey, there's this memo entry, and we're going to pretend like these tokens are yours. We're still going to put a piece of paper, and here's your token grant. And by the way, you should make an A3B election, which she does, but they never transferred the property. If you don't have that transfer, the IRS is going to say, you don't have an A3B election that's valid. And if those tokens are worth, I have a client, it's $2 billion of value. They never transferred the tokens. We're like, oh, I can't go back in time. We were not there. We came in later. It was a very successful layer 2. And I'm like, what? You didn't transfer the tokens? Like, what? And they're just like, it was too hard. It was too weird. We were worried about it. Can't go back in time. It's a problem. Huge tax bill. Okay. The reason that is because if you don't have this concept right, when the tokens vest and they're worth bazillions of dollars, it's income at that time, which is not just a problem for her, but what about the company? Because they still have withholding tax. So now I've got whatever 33% of withholding tax, and they're the withholding agent. They need to come up with that huge sum of money and remit it to the IRS when they vest. So I have a lot of anxiety on token comp. And I know that this is contrary to what some counsel would say about transferring property across. I fully appreciate that. But that's why, going back to the other slide, you got to have the attorneys and the accountants and the advisors and the coders all around that table, all around the Zoom party, say, how are we going to handle this? Because you don't know that you're going to be successful when they're doing these designs, right? We don't know. It's a test. We don't know. Could be great. Could be garbage. I don't know. But boy, if it's successful. Okay, I struck a couple of chords in here. I'm so sorry. What do you want to do? Yeah, yes, go ahead. Yeah, you could, I mean, people worry about this a lot. You could, like, there's is it pronounced genosis, right? You could set up a multi-sig. You could have different custodial arrangements so that nobody could just kind of run off or do something bad. Custody matters less. What you care about is that there's some element that is with the recipient, the human, the young lady in my example. One of the 3 keys. Yeah. Give one to her, one to a custodian, and one to the company, maybe. Yeah. Yeah. Yeah.
Talk about investors,
Mm.
oftentimes that also exists.
Yeah.
And what I see one of the flaws
Yeah.
Or
Yeah.
now it's the same logic where you want that to be separate from the employees, or can it be just a separate token issuance?
Yeah, if you, a token warrant for employee is a little bit different because you can't pretend that they're not an employee. And so this gets really tricky. Like if they're just part of a round and it's totally separate and it's the same terms as anybody, maybe, but that's not usually the case. If that was your question. So
More so just like, is the common practice of having just one clause conversion that each token still best versus separate
So the investor, always 2 separate pieces of paper, and the employee, yeah, you would have a different level of care because you have the comp rules. So, and I ran past all kinds of, there's like 49A, which is the deferred comp rules. There's all these other things that you need to consider in designing those plans if it's going to work. I just use a very basic example, like to prove a point that we need to make sure we get it. And by the way, if these are non-US people, 83B may not apply. You have different withholding tax considerations. So I'm trying to just get to some basics. You've been very
So
patient.
this model, and yeah, that did strike a chord with me earlier. This model works well with the labs, so maybe your founding team, but then you do the transfer and you go to hire new people. What do you do?
It's really tough. I have not seen a graceful solution to this. And it's like anything else, right? If you're not one of the core early stage people and you come in later, you're bound by whatever value that is. So then you have the choice, and a lot of people, what they've done is they've said, look, if like we appreciate that everything is value right now, we're going to have just a normal bonus program and we're going to bonus tokens. And then if you're flush with cash, maybe you gross it up and pay the withholding tax, right? And then you can back solve into how much you're going to give them based on the value. And so every quarter you say, what's my cash situation? What's my talent situation? And you back into what I should do. And maybe you send them across, or if you put vesting restrictions on them, you can do that. But if you make the 83B election, it's really hard because then you have a liquidity problem on the employee, don't you? Because you've said, well, this thing is worth $1 million. You don't have access to it yet. You can make your 83B election, but that means it's taxable today. Somebody's got to pay the $330,000. I don't know what the rates are today.
Is that 83B based off the like a known liquidity of the market? So that could be maybe
Yeah.
not market value, but that could be.
It's tricky. Okay, so we should. This is a sleeper topic that is like so much agita, right?
Many levels.
Yeah. So there's a little thing in this is code section 83, and it says to the extent that this instrument is compensatory, you may not consider lapsed restrictions in the valuation, which is weird because you've left the world of willing buyer, willing seller world, and you've said Congress put in this really punitive clause, and it's awful. Meaning that you can't, even if this thing vests for 3 years and Neil says, yeah, but there's all this volatility, it should discount by 60%, you can't consider that in a compensatory arrangement. So that means it's going to be really close to fair market value today. Really terrible. And we've seen people miss this. And we have tried all days from Sunday. We try to make it a different piece of property. The way this thing is written, it's not just a reg, it's sitting in the code. Like Congress put this in there. And there's examples in the Treasury regs and also in cases around securities, real estate, clearly no tokens yet. But we don't have a lot of range to operate on this one, and it's created a lot of agita because some people did take discounts based on those restrictions. And if it's challenged, low chance of success, maybe. And I think this is a topic that is on radar from the IRS perspective. Sorry, everybody's gonna need a cocktail after the session. That's right. That was a real story, by the way. I didn't bring it with me. Did I cover everybody? You had one. Yeah, all different kinds. That echoed really bad. All different types. Some will say, we have all this cash, and we appreciate that you came in later, but we really, really value having you around, and we know you want tokens, and say they're going to give you, all these tokens, value it. What is the withholding tax? Front the withholding tax. That becomes more compensation because they've withheld something and remitted on your behalf. So there's this gross up calculation. It ends up being like, I don't know, 47% of the amount, but you do have a happy employee. But then you can back solve for that number, right? What is the value today? What kind of cash can you deal with? Others would say, okay, don't want to deal with that. Too much money, we don't have that much cash. So the employee may write them a check for the withholding tax, or they may send across the tokens, withhold so many tokens, and then they would need to convert those to fiat at market rates, send the fiat, but what just happened to the company? They bought the tokens. So you have basis in the tokens that you recover, presumably at some later date. So unique basis tracking. Yes, sir.
What if you're dealing with contractors? And so you
Yeah.
wanna, like, transfer some funds from the wallet, lock it up, they deliver.
Yeah.
You unlock the funds. And then secondarily, like, how would this relate? You're just paying them on Bitcoin, like, same thing, you agree on a price, put it in the wallet, lock it up. then
Yeah.
the price changes
Yeah.
between, like, the delivery.
Great question. Okay, so contractors, I'm glad you said this, I didn't put on here, treated the same way as employees for compensatory purposes. It doesn't matter. The only thing that changes is withholding taxes. So there's no obligation in the US anyway to withhold tax if you're paying a contractor like you would an employee. But contractors have the same ability to make an 83B election if it happens right. The labs company still has to put it on a 1099. But the question is, you know, what do you put on there, right? When are you going to do it and what value do you use? So you got to make sure that the same construct is respected. And now I've forgotten your other question. Bitcoin. Same thing, right? If you're going to lock it up so that there's a restricted right to use or for whatever reason, then you would not be able to consider that in the valuation if it's compensatory. Yeah. I mean, it doesn't mean all these things have to be compensatory, right? We can imagine other different scenarios, but what's the common one is the employee and the contractor. And it's really just a comp problem in the valuation. I don't think we've run into other problems in valuation. It's just the comp. Yeah. 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 I mean, it's not uncommon for us to see massive volumes of this stuff. So like discount for lack of marketability, liquidity, whatever it is. But if that restriction's a factor, then it's a problem. Okay. Good. Good. What else we talked about? Having decentralized teams is really tricky, and I think COVID has really emphasized this because people are just kind of sitting around the world. And so, what do we find is levels of contribution, whether they're employees or contractors. It may not matter how they're classified, depending upon their role. So in my example, you've got coders sitting in Canada and in Germany who are making meaningful contributions, and they may be less on the radar of the locals if they're a contractor, but they're still going to be on radar. Again, agents are getting more and more sophisticated about where this stuff is coming. So the problem with this is, there's the comp stuff we've been talking about, but assuming that the labs company or the foundation is creating something really, really valuable and transacting in a way that is creating a lot of tax, say it's in the US, and all of a sudden, Canada and Germany, which are both very difficult jurisdictions to deal with from a transfer pricing perspective, like, you have humans here that were doing a lot of stuff, and they were part of what was going on. We have a right to tax what you did. You have a permanent establishment in my jurisdiction in Canada and Germany, and we want our share. And they're going to go after it. Now, in Canada and Germany, back to the comment on tax treaties, I forget who mentioned it, you may have the ability to recover that through competent authority. Like you let the different jurisdictions wrestle it out. You shouldn't have to pay more than, like, let them divide it up. But if it's a non-treaty jurisdiction, this becomes a real problem. So we see people doing more and more is if you have a lot of people in Germany, because one really talented coder is going to want 6 people on their team. So set up a German entity, right? Do the transfer pricing and keep the income tax anxiety level down so that they can tax only the amount of remuneration for their services. Or if you've got a smattering of people in 30 countries, like I don't want 30 entities, what I'm going to do, set up a GEC, a global employment company with a really good treaty network. Could even be in the US, could be in the UK. And what that does is it says, okay, imagine, I didn't put on the slide, imagine Labs has a subsidiary. Labs is US, maybe it's a UK sub because you got a lot of people in Europe. And you have a UK subsidiary and you've got somebody there who's the head of talent and somebody who's a coder that can supervise the rest. They happen to be sitting in the UK, but you have people, coders sitting in 30 different countries. We're going to let them be employed by and contracted by my UK company, the UK GEC. So what that does is, that's my employment company. It's a captive employment company. And they've got $10 million of comp, pay them a return. So now they've got, reimburse them by $1 million. You've got $11 million of income, 10 million of deduction, $1 million left, let it be taxed. No problem. Instead of the $1 billion that's sitting in labs and the IP that you want to protect. Because the other thing that happens is, when you have development that happens around the world, which is really, really valuable. All of you, many of you in the room can attest to how valuable these keystrokes really are. It doesn't take as much time anymore to code something that's incredibly valuable. And if that happened to take place in Germany, then when this protocol, this code, this app, this concept becomes really, really valuable, Germany may want to tax all of it. Like, that's where it originated. So we have to be really careful about capturing where things take place and put them in the right box. Create the narrative, put some substance around it. Real transfer pricing, real agreements, management decisions, board meetings, showing contemporaneous decisions of management about how you've structured it, acknowledging where it is at the time. And I know it's hard because it's early stage. It's like, good Lord, do we want to spend all this money on the front end? A lot of this stuff doesn't have to be that complicated. You could, with some coaching, you can do a lot of this stuff on the cheap, as long as you're thoughtful about what we're writing down, how we're agreeing with people. Setting up identity is not that hard. You're going to have payroll somewhere. Why not have another payroll run somewhere in the world? And you don't want to have 30 different fiat currencies to pay these people. USDC, like, make it go away, right? Just do your little drips of payroll and then remit your withholding once a quarter, whatever it is. Yeah.
International conversation.
Yeah.
I think, what I failed to say when I was talking about tax treaties is, and then Mika is coming online, is are any of these tax treaties spoken about how the IRS and other state, national level actors are getting pretty educated on this. What are going to be some of the first adoption of some of these conversations in tax treaty amendments in the next couple of years? What are going to be the good first?
It's a great question. It's a, I like the question a lot. What do we see? Cross-border transactions that look like debt instruments, but they're not based on currency anymore. People are using Bitcoin for intercompany transactions. And if you were going to withhold and remit Bitcoin, that's not part of a tax treaty. It's like general property. It's also not interest, because interest is only on money. And so, what should, I don't know what is going to happen. I've heard no data on this at all. But they don't let me into those rooms on the tax treaty stuff. Those are central banks and whatnot. But if they were smart, they would talk about debt instruments and royalties. Because right now it's going to fall into categories that are probably a little wonky, like general property, which are weird. So I would think debt instruments, interest, and royalties would be first. Do you have I don't know, Dave, if you have a perspective on that? Yeah. There's nothing right now. So we fall into either a general property argument, or does it resemble something else? But it's very unnatural. Now, the treaties still protect you from the normal core stuff, though, right? They protect you from permanent establishment risk or employees, and are they doing too much in a particular jurisdiction to drag you in? So the normal course actions were still good. But if we're crossing borders using crypto, then it's going to fall into general property probably. I've heard, as much as we've said there's no treaty, I haven't heard anybody taking action yet. I suspect they'll wait for things to play out with MiCA, which is probably the biggest piece of legislation that we're wrestling with. Let's see that play out in Europe. Maybe that pushes the US a little bit to get involved more thoughtfully and other parts of the world. Japan's being pretty progressive on DAOs, right? Singapore's been very thoughtful for a while, but still pretty gnarly on GST. There's GST there, yeah. Canada, pretty progressive, but so there's not quite jockeying for position yet, but maybe getting closer. Yeah, I don't know. Yes, sir.
In this conversation, most
Yeah. Yeah.
At what point subsidy set up? Because I guess the argument
Yeah. The EORs are helpful from an administrative perspective, not from a tax perspective. If you have an agent that really cares, it'd be like, that's your employee. Common law. Now, you may have a difference between common law and civil law jurisdictions, but I think under common law rules, right, this is where we're probably going to go. And so they're going to look straight through it. So set up your GEC and let them hire the EOR. Think about them as really good at admin, not tax protection. That's an extreme view, and I'm sure I have plenty of debates on this from different attorneys that would want that fight, but be careful. Because attorneys sometimes take positions because they know they're going to get paid to defend you on the fight. Careful, be careful. There's probably an attorney in the room or two that I just offended, but I just had to say it one time. Yeah, totally. If you care, only if you care about having something really valuable in labs protected from the other jurisdictions in the world. Most of the time we do, right? There's some really cool IP, there's something going on that we want to protect, and there's valuable actions taking place from these people. So segregate them in the other entity, making sure it's respected as a separate entity, and then you've encapsulated. And this is no different than any other legal entity structure from large companies. We just have different considerations at early stage companies, but yeah. And we see GECs as subsidiaries of foundations, of labs companies, C3s. It doesn't all you're doing is you're saying, let's not expose ourselves to tax liabilities in 30 different jurisdictions. We care more about this with crypto because it's so commonly misunderstood. Like, what is this stuff, right? It's just not, it's hard enough for us to get our heads around it. Imagine these agents, right? We have no chance. So it costs you a mint in exam. Keep it simple. Make a box. That's my advice. Okay, I don't know what else we don't. I can do whatever you guys want. We talked about foundations. This is interesting from a wallet treasury perspective, where we're getting a little more insight with the regs that just dropped on info reporting. But one thing that's important is we're going to have tokens, crypto, whatever it is, of different basis. And this is more of an example for an enterprise, but it demonstrates the point. So let's say you're an enterprise or a mature state labs company that is using tokens. I put Bitcoin here just because it was easy. Paying it to a customer, taking it from a customer to or from, right? Maybe redemptions, paying it to a vendor, paying it to employees. So you've got a hot operational wallet coming in and out, right? And so you're churning this fungible asset. And so basis tracking may not be that bad, maybe do it on the FIFO basis, but there might be some that you really care about. You might have some you might be a crypto OG, you might have $100 basis Bitcoin, right, in my example, or you may have 0 basis tokens that you really care about. And you don't want to use my 0 basis tokens or my $100 basis Bitcoin in a transaction because I'm going to trigger gain. When you use crypto in a transaction, it's a barter transaction. And we've not grown up with, as humans in this room, we've not grown up in a world of barter transactions. That was cave people when we exchanged clubs for meat thousands of years ago. We haven't done that in a long time. IRS didn't exist, but we're doing it now. And we're trading property that sometimes has really low basis for services or other property with a high value. So every time you do that, you trigger gain. So we care about which ones we use. So we developed wallet structures. And here we have cold wallets, or some would say cryo, like deeply protected. And so paying attention to the different wallets that you set up to track the basis, segregating fungible assets, the best protection. And there's plenty of people that say, oh my God, too hard, overkill, we don't need to do that stuff. I'm like, wow, how much is it worth? Right? A little bit of pain, set up some wallets, do your tracking, management intentions, segregate your basis. Doesn't have to be perfect, but at least you've got a method where you can specifically ID. So spec ID is an accounting method, but only in a world where you've segregated your fungible assets. The case law on this goes back to World War II with oil barrels and cotton bales. That's what we're dealing with. Yes, sir. The mixer, oh yeah. Well, ideally your mixer is sort of on the left over here. I would never recommend you to do that, but on the left side. But wallet structures are a big deal. Now, if you've got a bunch of churn in the hot wallet in the middle, then maybe you just do it with like a FIFO thing there, and it's going to closely approximate mark to market probably. But then when you really care about stuff, you hive it off into the right. Yeah, absolutely. You're right. Some level of segregation, accounts could be fine. Now, if it's an account, that is only a front-end representation and the actual address is omnibus, less defense. Okay? Our clients that have billions of dollars of Bitcoin, some with varied basis, would have separate addresses even within the custodians to have their $10,000 basis Bitcoin, the $20,000 basis Bitcoin, right? We really, really care about it. So management intentions, accounts, and separate addresses. If that's too hard and it's not worth that much money, at least you have separate accounts and you can designate management decisions and the rest. Yep.
When you're using wallets, you're really kind of accounts, or you'll just use like my MetaMask, and that's the only account that's just MetaMask.
Mhm.
Have multiple
Yeah.
in there,
Some level of segregation.
you're grouping by wallet.
That's right. Some level of identification, diversification. I just use it as an example. And people design this stuff very, very differently. It's not a one size fits all, but it's to demonstrate the point. If you really care, you put it in different places. Not just basis, but also character. Character matters. So if we have some that we're using in the business because I need it to run the business, that's going to be ordinary property. And some I'm holding for investment, it's capital. Two different tax treatments for a variety of different reasons. It matters a lot if you're crossing borders, if you're making charitable contributions, if you're talking about sourcing, if you're talking about states. So character matters for a variety of reasons. Yet another T-shirt. I might have that one. I'm going to look. Go ahead. I'm going to pull this.
Thinking back to 2018, kind of last time, this really mattered. Companies that were trading and had huge capital. We had huge gains in 17 and then had no money to pay their taxes. Are you seeing those get audited?
Yes.
People took LIFO positions and all kinds of fun stuff.
Can you read this? Character matters. Here's the reasons that it matters. I forgot the disclaimer. Somebody told me I should have put a disclaimer on the bottom because I'm giving tax advice. So I forgot that part. We do make T-shirts. We are seeing exam activity. Yeah. And then you're just like, oh, it was too long ago. The statute closed. Well, did it? Because we might have a 6-year statute if we have significant underrepresentation of tax by whatever math we want to do. The exam activity is really awful. It's really, really bad. And I alluded to some of this. This is the last thing I put in there. Books and records is a really big deal. Really big deal. Please pay attention to this. There's some of us in the room that are really, really good at this. Engage the bean counters. Be thoughtful about it. Write down what you're doing. Reconciling on-chain activity to your books and records. Oh, please do that. So the first thing they do is they say, give me a list of your addresses for IDR number 1. One line. Simple question, right? Great, no problem. Here's my addresses. What do? They query it all. And they're going to give this really long list. So they're going to say, now reconcile, please, all of these input and output transactions back to your books and records. And your head goes, and they're like, are you kidding me? Yeah, they're serious. So do that on a real-time basis, and then obviously reconciling your books and records to your tax returns. So that's really hard and really important. And again, if you're early stage, and do what makes sense, but don't forget to come back and do this before it gets too long, and do something along the journey. And sometimes the people you're using for crypto may not exist anymore. They may not have access to those books and records. So we've started telling clients is, hey, you better do downloads like on a monthly basis. Like, don't even send it to me, but keep it somewhere. Like that came up a little bit in this last round of returns. We're like, oh crap, got nothing. Can't go recreate it. They're gone. So that gets pretty gnarly. So books and records is a big deal. Transfer pricing is interesting. We live in a world where you have a period of time to put forth documentation to demonstrate why a transaction was arm's length. As long as you have it complete before the filing of your return, the rules say you're fine. But what happens if an agent says, well, you didn't actually confirm that for all these months later? What was the relationship of those parties? Like, how did you come up with that price? How did you know it made sense to make sure that was a prudent transaction? I'm like, oh. So they're questioning not the rule that you had time to debate against the penalties. They're questioning the integrity of management. How do you know that transaction was arm's length. That was a really hard conversation I had a few months ago in the city with an agent. So, and documenting, why did you choose that date in the range? What is transfer price? You get a range. Somewhere between this and that, interquartile ranges becomes our safe harbor, I think. So how did you choose that point? Write it down. Put it in the board meeting minute, something. So transfer price has become a big deal. A lot of this stuff crosses the boards we talked about. And I think we've gone through the Cayman stuff. Make sure you have substance. Any actions that happen associated with your Cayman entity, write it down, make sure it's clean. If you're transferring tokens and they're in the Cayman entity, do it from there. Right? Don't do it from here. Because then the US is going to want to tax it probably. So a lot of sensitivity around Cayman, more than the other treaty countries, but still for all of them. I don't know what time it is. It's like
I'm
1
not
o'clock.
stopping you, just,
This is all I do. So happy to talk more. Is this stuff helpful? Has this been good? Okay. We do lots. I mean, we spend a lot of time on the labs example here. We span all different aspects of the ecosystem, whether it's funds, whether it's high net worth individuals, family offices, enterprise getting into the space, whatever it is. But I thought this crowd was more on the lab side and startup, but we can go anywhere you want. Yes, sir.
I'll throw a curveball.
Yeah.
Okay, now you start incorporating CDBCs
Oh.
into your treasuries, or CDBCs into your wallets, or CDBCs
Yeah.
into your smart contracts
Yeah.
that are then automating
Yeah.
and executing and
Yeah.
on L2s.
Yeah.
And how is that a solution or complicated sometimes?
It's money. Currency. 988, 987. Yep. Issued by a central bank.
So that can help.
For sure. When we get there. Yeah. We can't apply rules on money yet because it's not money. It's property of some kind. But when the central banks start issuing, for sure. If you want to use the Chinese digital yuan in your transactions, that would be money. It's issued by the Central Bank of China. They have a name that I don't remember. Have they issued CBDC?
That's one thing I'm looking at.
They're on. I mean, the Brits are very advanced right now. Where else have we seen it? I think the Brits might be the first of the G20. I'm not positive, but they're pretty advanced. Brits. Sorry, the British. I can't say the Queen anymore. She's passed.
not relating to the current slide, but when if an entity loans out its tokens, let's say to a market maker, and the remaining control is left, is no longer there. Is there an adjustment to cost basis, and is there capital gains implications at the time of the loan?
Yeah, we see a lot of analogies of digital asset lending or crypto lending to sec lending or securities lending. Securities lending was a safe harbor, this is code section 1058, that came about when there was a policy change in the IRS to a long-standing tradition where people, primarily on Wall Street, would lend securities so that they can have other activities. And then there was just a long-standing industry practice that was respected as a loan, even though they were outside of your control and used for other stuff. And there was a change in policy in the IRS. This was in the 70s, I think. And the director's like, no, this is all taxable. So Congress stepped in and clarified, no, this is a thing. They enacted the safe harbor. It doesn't apply to crypto. So we can analogize to it, and it has been part of 4 to 5 proposed bills coming around. I think a lot of people are sympathetic to this, and if you believe in the markets, you need sec lending to be applied to crypto. It just doesn't exist today. So you can sometimes, with certain facts and circumstances, get to a position that it would be respected as a loan to some extent. So you have a line of defense, but it's not a sure thing. So we see opinions written on this all the time.
And I mean, the role of market makers, which is a totally separate
Yeah.
conversation to be had, but has the IRS gone after, has there been much enforcement, if we've got a project and we want to make a market, so
Yeah.
there's liquidity out there, and all of a sudden we give, 5 million, thinly traded at Uniswap, whatever, and, you give away $5 million worth of your token, or 50 million, whatever that is. Does that mean that I've got cap gains on that?
So there is definitely risk. I know the IRS is aware of it. They've had a number of parties ask for private letter rulings, none of which have been granted, to the best of my knowledge. So there's risk on the transaction, but there's many opinions written by accounting firms and law firms that say it's not recognized yet for tax purposes, but it's not going to be like a should level of opinion. It's going to be something less. So there's risk on it. Yeah. And there's things you can do in the design of those instruments to keep you on the wider shade of gray, probably. Somebody asked a little while ago, and maybe I didn't address it. So if you contract in fiat and settle in crypto, then that's a barter transaction like I've been talking about. If you actually contract in crypto and sell in crypto, the Oakland A's did this. Did you guys catch this? When you could buy a suite for 1 Bitcoin. This is a few years ago. It's pretty interesting. And so this is a weird accounting nuance, but you would have whatever the price of the Bitcoin was. I think it was like 44 or something at the time that they inked the contract. So that would have been revenue amortized over the life of the contract at 44, but then it went up to 50, and that created a derivative. Only accounting, non-tax consequence, but just a little nuance to how you're contracting. And so we see this, if you care about bookkeeping, if you care about financials, if you care about GAAP or IFRS, that's a thing. So watch out for that. So a lot of stuff in accounting. We've talked about these things. We talked about indirect, which is VAT, payroll taxes. Info reporting, there was a 278-page reg package that dropped on Friday about info reporting. This is all about 1099s. It's proposed. It will become final because the effective date is anchored on the final date, not the proposed date. There's a comment period till October. There's a hearing in November. We'll probably see them go final soon, such that they can honor the Jan 125 start date for tracking transactions. So this will start. You'll start to see this on a 1099 DA for digital assets. So that will happen soon. And there's also a cost basis component to that, much like you see on your brokerage statements with real security. So that's coming soon. Yeah. Yeah, I frankly don't see pushback. I think what this has created one of the biggest problems that the service has seen is most humans don't know what to put on their tax return unless they get a W-2 or a 1099. They just don't, right? Most people don't know what to do. But the rules didn't apply. They were confusing, whatever it was. And so I think most exchanges are like, thank you for clarifying. Now we know how to do this. So now we can get the wheels in motion. Yes, it's expensive. Most of their customers want it. Most exchanges have some reporting package anyway to get what you need to put it on your return. But to have it on a form pulls the anxiety out of that conversation between a consumer or retail and the IRS. Yeah. Yes. So platforms, for sure. It is very far-reaching. I don't know where that will land. I don't think it was as far-reaching until the OECD put in rules, which I think this was the CARF legislation, which went all the way to DeFi, which might have been one of the reasons it took so long to get the reg package in the US, because the OECD went so far that we couldn't stay narrow. When Congress enacted the upgrade to 6045, which was in the fall of 21, they specifically carved out certain components and said, we're going to leave the DeFi stuff until later. This happened on the congressional floor, I think it's called colloquy, when they were having these little debates, which does become public record. And that is instructive, not mandatory, but instructive for Treasury when they're drafting the regulations. The problem is CARF. They went further. So they expanded the reg package to address things because they had to. Practically, very difficult. Very, very difficult. But it's also in line with a lot of the other stuff that FinCEN is worried about, right? How do you know who these people are? And so there might be some things that are running in parity between general KYC AML and what's coming out from the IRS. Maybe. Yeah.
Change the subject maybe, or focusing down, you spoke a little bit about pending comment periods and rulemaking periods, and when the reporting period, and that's pretty far out. We can start planning for 2025, 2026.
Yes.
Could you speak on Assembly Bill 39 here in California, stablecoin provisions going in, potentially January 1 that say all stablecoins need to be issued by banks if they touch a covered person in California. And then the definition, obviously, of a digital financial asset activity embedded within Senate Bill 39. And it is super broad, it licenses
Yeah.
steroids. And it's going to go through the suspense file and probably become law because nobody's organized inside that yet.
Yeah, I cannot speak to that. I've heard anecdotally. I've not studied anything around that. Thank you for being here. Yeah. Has anybody else studied what's happening in California? I know there's a few VC firms locally that have been active on various bills in California, including what the equivalent of a bit license would look like, and also DAO legislation here. Those are two topics that I know are being lobbied pretty heavily. I've not heard anything on the stablecoin. I'm sorry, I don't. I'll look at it. Yeah. Yeah. Yeah.
Which is bid licenses on steroids as well as providing conditional licensure for those holders of bid licenses as of January 2023. But the stablecoin provision explicitly says that it will be backed by U.S. Treasury.
Interesting.
2602 assets, and it goes into effect January 1, and they must be issued
Of next.
and January 1 of 2024. So in terms of the rulemaking and the comment period, and how the hell is the government administration going to get this done?
We can check with Bruce later and see what he's heard. I don't know. I should know about this. I'm glad you raised it. Yeah. No, it's important. Good times? Is this okay?
We've got lunch too, if people want to grab some food.
I don't know if I covered anything else.
And Rob, what's your schedule?
I'm around. I plan on just hanging out. So you have a lovely facility here. So I'm just going to hang out. I have a couple of calls I need to take, but I'll be around. Happy to engage. This is all I do. I don't touch fiat anymore. My wife handles fiat transactions. I do crypto, and so that's how we divide the household. But it's been fun. Thank you. Thank you for having me. Thank you.
You'd be awesome for an interview there.
One more time.